Hello everyone, welcome to Anu's classroom. In this video, we will do a very quick revision on managerial economics. Alright, so managerial economics, a word which is derived from two words, manage and economics. So what do we mean by that? See, when most probably questions from block 1 would, be looking at questions like that. Like, what do you understand by managerial economics, or what is the scope, what is the nature? Such kind of questions might come. So if such questions come, it will be a very good idea that you start by saying what economics is, what management is, and then say what managerial economics is as the introduction. Then you can go on and say about the scope or the nature, objectives, and things like that, whatever is being asked in the question. So I would say it would be very nice if any question coming from block 1 you can answer by starting with your understanding of what managerial economics is. Would be good. Definitely depends upon the type of the question asked, of course, but this is a suggestion. So what is economics? Let us start by defining what economics is. Economics is is the study of human activity related to commerce, right? Economics, the study of nature and uses of wealth, is what economics is, both at the national level as well as the individual level. Okay, so that there are multiple definitions of economics. If you are able to memorize any of it, it would be great. But basically, let's say at least this you must know, that economics is the study of the nature and uses of national wealth. This is was stated by Adam Smith, the father of economics. So economics has two aspects: microeconomics and macroeconomics. Now, both of these things are not poles apart or anything. Both of them have similar concepts, similar principles, and everything. The only actual difference between this micro and macroeconomics lies in where these principles are being used. So, economics, when we say economics, is the study of how humans work together to convert their limited resources, or in other words, wealth, into goods and services to satisfy their wants, which are usually unlimited. So, scarce resources or wealth converted into unlimited wants. And how they distribute these goods and services among themselves is what economics is all about. So, microeconomics, micro meaning small, is the study of a particular individual consumer's consumption practices, or even of a firm. So, in case you get questions about the theory of firm, this is what you have to write. Microeconomic theories is what you need to write. That is what you need to understand. Then coming to macroeconomics, macro meaning what? It is large. So, it is the study of the aggregate or the total economic activity of a country. So, things like the gross income, gross profit, GDP, such things will come into picture, because it is at a larger scale. It is not limited to just a firm or just an individual, but rather whole markets and whole industries. So in this case, in my macroeconomics, we mostly are concerned with how economic resources or the factors of production, like say the land, labor, or capital, technology, such things, flow from the resource owner, that is the factor market, to the business firms, and from the business firm to households or the consumer market. So how that what you can say, the flow of goods and services and capital, that part, that cyclical flow between consumer market and factor market, factories and customers, that flow is what macroeconomics talks about. The next word in this managerial economics is actually management. So management is not something new to us, right? We are managerial aspirants, MBA aspirants. So what is management? It is the science and art of getting things done through people in a formally organized groups, right? So it includes what all things? The five functions of management: planning, organizing, staffing, control, directing, and controlling. All these things are functions of management. It is getting things done through other people, combined efforts of others in an organization, is what management is. So what is managerial economics? It is mainly what goes the economics of taking managerial decisions, or how economic principles are to be considered in performing these managerial functions, is what managerial economics talks about. So it is the linkage between economic principles to the firm's managerial decision making processes. Okay, so that is the main linkage between that is the reason why this whole managerial economics as a different branch of study even has been brought forth, because a firm being operating in an economic environment needs to know about the economic principles so as to take wealth related decisions, demand and supply related decisions, cost related decisions, and all those things, pricing related decisions and everything, judiciously according to its environment, to know its economic environment much better. So question might come as to talk about the linkage between economics and decision making. So this is the whole concept which you have to base your answer on. If you can read by heart any what you can say definition of managerial economics and go, it would be great. So what are the nature of managerial economics? It is both, it includes both micro and macroeconomics, right? It is close to microeconomics because when we talk about the firm, it is a microeconomic aspect, but it operates against the backdrop of macroeconomics. Why? Because the firm operates in a global environment, and in the global environment, macroeconomics is taking place. But for the firm, it is micro. So it is an amalgamation of both micro and macroeconomic principles. It is a very normative way of study. It doesn't tell you should do it, but uh, or yeah, it kind of tells you should be doing this or you ought to be doing this. It doesn't say that this is going to be bad or this is going to be good, or this is what you're doing is right or what you're doing is wrong. That is not what happens, but it is kind of like a suggestive things. You ought to do that in this particular situation. I think you should increase your demand, or I think you must stop this merger. Something like suggestive things. Okay, prescriptive actions are given. It is a totally applied science or an applied art. Okay, it is these economic models, managerial economic models, are built on real life data, right? Real life complex business situations, so as to give real life answers to real life problems, or at least suggestions. So there is a scope here to evaluate from the economic standpoint the benefits or drawbacks of each of the various alternatives which a firm might have for its decision making. It is a very interdisciplinary aspect. It includes a lot of things: microeconomics, macroeconomics, accounting, lots and lots of what you can say, it includes mathematics, statistics. All those things are involved in this managerial economics. Even organizational behavior, psychology, sociology, all these things come into picture in managerial economics. And any managerial economic principle is based on certain assumptions, as well as they have certain limitations also. So these principles, whatever we derive, all come tagged with assumptions. If any of those assumptions are not met, then we cannot say for sure that that particular economic principle will be 100% applicable to your scenario, right? So the validity of these concepts or theories of managerial economics is not at all universal. It is a case by case thing. Whichever suits our scenario the best, we should be using that principle. Coming to the scope of managerial economics, you can say you can apply managerial economics for forecasting your demand, right? Demand analysis, for cost analysis, for taking pricing decisions, to understand production as well as supply, for analyzing your profits, for helping capital management, for strategic planning. All those things, managerial economic concepts will help you. So there are 6 basic principles of managerial economics. They are incremental principle, time perspective, opportunity cost, equimarginalism, discounting principle, and marginalism. Okay, we have equimarginalism, marginalism, discounting principle, opportunity cost, time perspective, and incremental principle. So in case a question comes asking you to talk about the principles on which managerial economics is based upon, then you can write this. Or if it is a generic introductory question on what do you understand by managerial economics or something like that, also you can include this in a short form. Okay, it will be helpful in increasing the length of your answer as well as the depth of it. Okay, so what are these principles? We will just quickly touch upon them. I will not spend a lot of time, but let us quickly touch upon this. So first is the incremental principle. What is incremental principle? According to this incremental principle, it deals with or it asks us to find the incremental cost and the incremental revenue with an incremental change in production. Okay, so in case, suppose say you are producing 100 goods. If you decide to produce 102 goods, then what is the incremental cost that you will have to produce that extra, and what is the incremental revenue you will gain from that? Okay, kind of like marginal, but it is called incremental concept. Okay, so it is one of the very important concepts in economics. It is frequently used also, and it is definitely closely related to this marginal concept, marginal principle of economics. So accordingly, the incremental principle states that if you are taking a decision regarding an increase in your production or whatever it is, then that particular decision can be called as profitable if it satisfies these four conditions. That is, it will increase your revenue more than costs. Okay, or it decreases some costs at a higher level than it increases other costs. Like for example, say some purchase decision you made, okay, or some raw material supplier you are changing, but then say what else, suppose say you are a tile manufacturing company, okay, and you decided that you are switching the say the ceramic clay supplier of yours. Suppose say you were actually purchasing from a local supplier who was giving you, I don't know what the price of ceramic clay is actually, but let us assume that per kg you are getting it for 100 rupees. I don't know whether it is a long shot or a very negative shot, but let's assume anyways you're getting it for 100 rupees, say. Now you decide, now you are changing the uh, supplier. Okay, the new supplier will say will give you the same thing for or else wait, let us switch the case. Okay, that will be much more easier to understand. So you are getting for 100 rupees from a supplier who is a little bit far away. Should I make him far? Okay, yeah, he is far away. Okay, a very far away supplier. Okay, and to get this raw material to your company, you are having to spend 50 rupees for transportation. Now you decide that you're going to shift your supplier and you're going to take the material from somebody closer to home, but you will have to give them 120 rupees per kg. So you were getting the material for 100 rupees. Now you can get it for now you will get it for 120 rupees. So actually you're seeing that the cost is increasing here, right? But the good thing is that the transportation cost will be zero, say. Since maybe you are in the same locality, the supplier agreed that he will deliver the materials to you free of charge. No delivery charge required. So now what happened? It decreased some costs, that is the transportation cost, more than it increased some other costs. So in that case also, incremental principle says that your decision is right. Similarly, it might in opposite case, you can think about revenue. Okay, it increases some revenue more than it decreases others, or it might reduce the cost more than it could reduce your revenue. Okay, so either case, all these way, finally your profit should be, or your revenue, the difference, the profit should be at the positive side. Okay, so that is the concept of incremental principle. I hope you are clear of that right now. Coming to the concept of time perspective, here the decision maker, this economic principle is saying that the decision maker has to give consideration to both the long run as well as short run effects of his decisions. So short run as in maybe within 5 years, how that decision is going to affect his demand or supply or whatever it is, or cost, and also in the long run, maybe in 10-15 years, how this would happen, because decisions once taken is taken, you cannot go back in time and change it. So that is the time perspective. Say it is very closely related again to this discounting principle. What discounting principle is, yeah, since it is related, let me talk about discounting principle also along with the time perspective. So discounting principle states that actually time, you all are aware of the time value of money. I believe that a rupee today is not has more value than rupee tomorrow, right? Today's 1 rupee is worth more than tomorrow's 1 rupee. That is, money or monetary value or whatever wealth's value actually decreases. That is the whole discounting principle. So when you take any decision, you must consider the present as well as the future value of money and come to a good decision. Okay, like say if a decision which gives you 100 rupees today will only give you 100 rupees in the next 5 years also, then that is not a good decision, because 100 rupee today is worth much more than 100 rupee after 5 years. So in effect, if you use the discounting principle and bring and trace back the value of the 100 rupees in 10 years, you might be surprised that maybe it is not even worth 50 rupees today. So in effect, even though you don't see it in your accounting books, it is something that is actually bringing you loss. I hope you understood. I hope I didn't make it confusing. In case you have doubts, feel free to drop it in the comment section below. I will try my best to answer them within before your examinations are up, right? So the next one is the opportunity cost principle. So that is talking about the opportunity cost which comes with any decision. Whenever you choose one alternative, you are choosing not to follow all the other alternatives. So that is an opportunity missed, right? So we should be aware of the opportunity costs involved with all the other alternatives, and we should choose the best alternative so as to minimize the opportunity cost as much as possible, is what this opportunity cost principle says. Then is the equimarginal principle. So equimarginal principle, again, it is kind of linked to your incremental principle. So in equimarginal concept, it states that whenever you allocate input for the production of output, you must do so such that the value added by the last unit is the same in all cases. Okay, so that is, suppose say a firm has 100 people working with them. Okay, now the firm is involved in, let's say, five activities A, B, C, D. It has 100 people working, and it has five A, B, C, D, E, five activities. So we can say that you can divide 20-20 each, right, to all these activities and get it done. But the thing is, the activity A might it is possible that to complete activity A successfully, you just need 10 people working. So the rest 10 people are actually additional in activity A. But activity D, to ensure completion in that same amount of time as activity A completes, maybe would require 30 people. So this extra 10 people which you otherwise would have put it over here, if you give it to D, then these processes can work faster, more efficiently. Otherwise D would lag behind, right? So if these are series of if these are parallel operations which are all linked to another operation, or which are all dependencies of another operation, if you simply divide equally and D doesn't complete on time, there is no point in A, B, C and E completing on time, because the next process in line which is dependent on all these will have to wait till D completes its processing, right? So it leads up to piling up and lagging and bottlenecks in the production line. So that should not be done. So that is what equimarginal concept is telling you. Okay, so I hope that is clear. The last one is the marginal principle. So marginalism, the key focus here is how much extra use can be gained from the incremental increase in the quantity of goods that are either created or sold, and how these measures relate to consumers' choice and demand. Okay, so it covers topics like our marginal utility, marginal gain, marginal rates of substitution, opportunity cost, all those things are involved here in the marginal principle. So this incremental principle, equimarginalism, marginalism, all these things are kind of like interlinked. And so is this opportunity cost. Time perspective and discounting are also linked, or what you can say, they are almost the same. Not almost the same, though they are different, they feel the same. So these are the six basic principles of managerial economics. Make sure that you don't mess them up. Make sure that you know which is which when you write. Okay, because otherwise the whole point of writing this will be lost. So that is so that is the basic principles of managerial economics. The next important topic that we have to know about in managerial economics is about the demand analysis. So what is demand? Demand, normally when we say demand, is the desire for an object. But in economics, it is not just the desire. Okay, desire is just the willingness to buy. But in economics, when we say that there is a demand for something, it means that the consumers are willing and able to buy. Okay, so demand is that willingness. Okay, that willingness that is backed by purchasing power. Only then your consumers are going to come and buy, right? Otherwise what it is, it is, if see, like for example, I desire for a BMW, or I desire for an Audi. Why not? So does that mean there is demand for Audi from me? No, I don't have that kind of money with me. Right. So just because I want to, or I would love to purchase it, doesn't mean anything to the firm, as long as I actually have the money and I go and buy it from them. So that is the basic thing about demand analysis. Okay. Sorry, that is the basic thing about demand. So for demand in managerial economics, it has three essential traits, you can say. That is price, the quantity demanded, and the time. Okay, so these three are important for demand. There are various types of demand for consumer goods versus your what do you say, producer goods. Consumers, when you talk about demand from consumers, say we demand for bread, apple, rice, things like that, lace, bingo, cake, such things. But producers of these things would demand for seeds, machinery, raw materials, things like that. So that is the demand from the consumer versus that of a producer. Similarly, autonomous and derived demands are there. Oh, so I went ahead and wrote down the various types of demand. Okay, so autonomous versus derived demand. Can you think of any examples? The requirement for a school in an area, in a village, that is an autonomous demand. It is needed so that the children can learn. But once a school gets set up and children start coming, a stationery shop gets set up there. A printing, say a DTP printing and scanning, emailing, internet cafe comes up. Canteens might come up. Vendors will start coming up. Why? Because they see an opportunity there. Those things are derived demands. Similarly, demand for durable goods are also there. Demand for perishable goods are there. Demand for a firm is different from that of an industry. Short run and long run demands would be there. Demands for new product versus the demand for replacement. Like for example, recently my computer, my laptop, if you guys, I don't know whether you guys knew, my laptop went for a strike. So I think it's something had to be replaced. So either I can go for a new product or I can choose to restore it, replace the broken parts, right? So then there are two types of demands that could come up. Similarly, the demand of from a total market versus that from a segmented market, all these things are various types of demand. Now, a demand has a lot of determinants, right? So what are the determinants of demand? I'll go ahead and write them down. So these are some of the determinants of demand, like the price of product, the price of related goods, consumers' income, consumers' tastes and preferences, advertisement expenses, consumers' expectations, population of the country, distribution of national income, the income of that particular consumer. Yeah, that is already there, consumers' income. So all these things are determinants of demand. Yeah, price of related goods means substitutes, complements, all those things, income of the consumer. Yeah, I hope you guys are aware of all these determinants, right? I'm not explaining them again. So these determinants, how they translate or what is their relationship to the actual demand. Okay, what is the relationship of these determinants to that of your demand is what a demand function expresses. Okay, so it expresses the relationship between the quantity demanded of a particular commodity and its determinants. So all these determinants might not have the same effect on the demand, quantity demanded of a particular object, right? Say for example, salt, the consumers income and all does not affect its demand, right? But definitely if you talk about something like lace and all, then the consumer's taste and preferences, all our income, such kind, or the demand for luxury goods, they all depend upon these things. So not all the consumer goods or not all goods have all these same determinants. Similarly, some of these determinants have a positive income impact on the demand, whereas some of them have a negative relationship with the demand. All those things are there. So basically what you need to know about the demand function is that it represents the relationship between the quantity demanded and the determination of the demand. So out of all the variable determinants which are listed here, okay, only some of the determinants or some of the variables would represent the demand for certain what you can say, certain commodities, and demand is inversely related to some of these variables. It is directly related to some others. Some of these variables are very easy to quantify, like price of our product or price of related commodities or income, interest rates, expenditure on investment. Such things are very easy to quantify, but some things like consumers taste and preference and all, or consumers expectations are not that easily quantifiable. Then the demand of the degree of control each firm might have on these determinants are also variable. So that was about the demand function. Next, let us talk about the law of demand. So I got a few suggestions saying that lengthy videos are very difficult to follow. So maybe we will have a logical break over here with the demand function, and from the remaining topics I will upload a new video. Let me know, okay, what is your preference, whether you want one video which covers the entire concept, especially in terms of quick revision. Do you want just one video wherein you can pause and come back later, or do you want multiple videos? I would whichever is convenient for you guys, I will take it up. I will do it accordingly, whichever is having majority opinion, because both have its own benefits and its own limitations, right? So let me know in the comments if you guys prefer shorter videos in multiple parts covering the entire thing, or long one video covering the entire thing. And depending upon your suggestions, I will prepare the videos from now on. Okay, so let us break it over here. From the next video we will talk about the remaining concepts in managerial economics.